And thank you so much for taking some time out of your Wednesday evening to learn about this. I work for a group at Nationwide called the Nationwide Retirement Institute. And this is what we do. We break down and simplify a lot of these more complex retirement issues or questions that people have. And certainly over the 13 years that we've been talking about Social Security, there never seems to be a dulling in the appetite for this kind of information. So I'm going to take myself off of video. I'm going to share the screen and we will get right into what we call Social Security, the choice of a lifetime. And that topic or title, pardon me, was really carefully selected because this could be, when it comes to your financial affairs, certainly a lot of the groundwork of how you begin your financial retirement income plan, but also failure to make a decision that might be in your best interest could mean that it is a lifetime of missed opportunity or a lifetime of lost income possibilities. So with that in mind, that's what we're going to be talking about tonight. And you saw, of course, on the invitation, there were a lot of different things that we will address. When I am done, should you have additional questions after you've had some time to digest and absorb this, or you've watched the replay, by all means, reach out to your CNA team. They will refer any or all questions to us, and we can help you that way as well. So as I mentioned, I work for a group called the Nationwide Retirement Institute. And just a couple of disclaimers, if you will, around all of this. Number one is that I am not here to be giving you any tax advice. I'm certainly not giving you any legal advice. And your CNA team is your financial professional. That's not me. I've been in the financial services business for over 30 years. But at the same time, I'm not going to be giving you advice. That's not my role. My role is to really dissect a lot of the Social Security rules, tell you what people think that might not be correct, and give you some food for thought. The other thing we're not going to talk about is any nationwide product. We are here simply in an educational capacity. And so that's really what I'm going to be working from today. So first of all, I think a lot of people, if not all of the people on the call this evening, know that you can claim as early as age 62. You could claim even as late as 70. Certainly there's no feet to the fire regarding claiming when you elect to do that. If you don't claim at 70, that's okay. But quite frankly, you'll be leaving money on the table. But the important thing that I want to share with you is that differential is a pretty good swing. And the difference between claiming at 62 and claiming at 70, and these are hypothetical numbers here, but the 77% number there is not hypothetical. That is actually the difference between these two claiming ages. And I always like to think when I share this information with people about making the analogy between if you are working right now, a paycheck that you're receiving, and Social Security. And Social Security is simply the paycheck you are receiving in retirement. And happily, on Friday of this week, I get paid at my job. I would no sooner go to Nationwide and say, you know what, I'm okay taking a reduction in my pay than I would fly to the moon. But also, if I could massage my paycheck so that I could get a much bigger paycheck, I would be very interested in doing that, although I'm not able to massage it quite to the point where I'd get a differential of 77%. But still, that is a very big deal. And it's something that people really want to pay attention to. As we go further, I will tell you a couple of things about claiming. And that is, we are not going to tell you to claim it at 70 or later or wait. We're not going to tell you to claim it early. We are going to tell you to take this seriously and make sure that you look at this decision within the context of all of your other income streams that you have available to you in retirement. So we're not going to push you one way or the other. Again, that's your decision to make, but just show you what the pros and cons are of maybe these different decisions. So with that, we're going to talk about these three things this evening. We're going to talk a little more about why we call this the choice of a lifetime. I'm going to then move over and review some basics with you. And as I love to say, There's really nothing basic about Social Security. And then finally, there is something that your CNA team has available through Nationwide that is a tool. It's called our 360 Analyzer. And I'll show you a little bit about how that works. But the bottom line on the guidance point number 3 is that this can create for you a report that will show you 3 or 4 different customized claiming options that have been created just for you. You'll see how that works before we're done this evening. Well, let's get started and flesh out a little bit more about why we call this the choice of a lifetime. And interestingly, when you look last year, and we got this information from our friends at Social Security, what we discovered was that about 26% of people claimed as soon as they possibly could. The minute they were 62 years old, they blew the candles out on their 62nd birthday cake, and they went to the Social Security website and they signed up. Then there's another group of people, that's 24%, and they signed up before an age known as full retirement age. Full retirement age is something that's very critical to your claiming decision, as you'll see why in just a couple of moments. But when you add it up, about 50% of individuals filed before full retirement age. I'm going to go back to this 24% thing for just a moment because I don't think I said it exactly as clearly as I could have. 24%, they didn't file as soon as they possibly could, but they filed before their full retirement age. And so consequently, these two groups of people in the blue bars filed before full retirement age or early, and therefore they left money on the table than if they had waited till full retirement age. Now, we do a lot of polling and a lot of research and a lot of focus groups, and we find out that a great deal of individuals really do not know what their own full retirement age is. So I'll explain it first, and then we'll go through the numbers. Your full retirement age is the age at which, once you turn it, you are eligible for 100% of any benefit that you're eligible for. So whether that's a benefit based on your own work record, whether it's a benefit based on your status as a spouse or a divorced spouse, whatever your benefits that are that you're eligible for, if you wait till full retirement age, then you will get 100% of them. Now, when we're talking about your own check, the one that you got as a consequence of you working, if you claim early, and this is the case for everybody, if you claim early, there will be a reduction in your benefit. And how much depends upon how early you actually claimed. That's for everybody. But if we're talking about your own check based on your work history, if you delay past full retirement age, then there are credits available to you. And that works out to be about 8% per year. It's pro rata. So it does not mean you must wait for an entire year to get that 8%. If you wait, say, for half a year past full retirement age, you get half of the 8%, which is 4%. So delaying your own benefit results in an increased check. But the other thing about this delay, don't wait past 70 because those 8% credits stop then. They don't go on further and further and further. Once you claim your benefit, then you've kind of put a toe in the sand, and those delays would then cease. So we'll talk more about this as we go forward, but I do want to get to these birth years. Your full retirement age is contingent upon the year you were born. Very simple. If I were born in 1957, my full retirement age is 66 and 6 months. If I were born in 1960 or later, everybody born in 1960 or later has a full retirement age of 67. So the takeaway here is don't be fooled into thinking your full retirement age is 65. Kind of makes sense because that's when people retire. That's when you can claim Medicare. But when it comes to getting, at the very least, all of the benefit that you're entitled to, you want to wait till full retirement age. So moving on, I'm going to introduce you to Pat and Kelly. They're a married couple. They've been married to each other all their adult life. And what that is telling me is that there are no auxiliary benefits that need to be considered when looking at their options. And what we mean by auxiliary benefits are things like a benefit you could claim off your spouse, a benefit that you would receive perhaps as a surviving spouse, things like that. We're just looking, I'm sorry, I meant to say, they're not looking at benefits as a surviving spouse or a divorced spouse, but they would be eligible for benefits based on their status as a spouse. Pat is 66. He is full retirement age. Kelly is 61. She has not even been at the age where she can claim it yet. Remember, she can't do that until she's 62 years old. Now, if they go ahead and file as soon as they possibly can, remember, Kelly's got to wait a year, but Pat could file right away, then their cumulative benefits are $1,551,114. And at that point, I like to pause for just a moment and say, for a lot of people, this is one of the biggest retirement income streams that they have. So that's another reason that we call this the choice of a lifetime. But if we stretch this out a little bit further and say, well, what if? What if Pat and Kelly delayed claiming? Maybe Kelly didn't file at 62, maybe she did later, and they took advantage of all of the rules that are available to them. In that case, and we're using the exact same life expectancy pairs. So we're assuming Pat's going to live to 85, Kelly's going to live to 88. That's the same in each scenario. But in the second scenario, now that income stream adds up to $1,781,028, and the differential there is close to $230,000. That's the amount they would have left on the table just by claiming as soon as they possibly could. Now, to me, that's a lot of money, probably is to you as well, but we wanted to monetize this decision and show you actually what the consequence to Pat and Kelly would be by those two alternatives. So with that as a backdrop, and hopefully I've gotten your attention, we're going to move into the second part of this, and we're going to look at some of the basics. And I like to do this because, first of all, it lays a really good groundwork of some of the things we'll talk about going forward. And the second reason is, as we do this presentation, I'm part of a field team, and we deliver this content in person and via a webinar like I am this evening with you all. We deliver this many times per year. And so we know what people misunderstand, what kind of questions they would ask, kind of their thought process. So I also want to share with you what the common misconceptions are, so that if you are thinking that, or somebody tells you that, a neighbor, a family member, whatever it is, then you'll know really what the true story is. Well, first of all, we're going to go way back, and I'm going to talk briefly about what Social Security really provides to you. So first off, what you've got here is a guaranteed lifetime income stream. Now, there's been a lot of noise lately about the Social Security Trust Fund going to zero in the year 2033. At that point, you would still receive a check. You would still receive a guaranteed life or guaranteed check that will last for the rest of your life. However, some estimates are saying that if that's the case, and there are no legislative bills passed in order to bring some solvency back to Social Security, then it is possible that people would receive a 20% reduction in their check. Stay tuned for that, more to come, but at least you would still get it for the rest of your life, and it is guaranteed. Second thing, and this is where a lot of people get this wrong, you do get an annual cost of living increase. It is indexed to inflation every year, somewhere around October. They do a calculation that determines what the next year's cost of living adjustment would be. And that cost of living adjustment starts getting added to your benefit when you are 62 years old, but you do not have to claim it in order to trigger the cost of living adjustment. In other words, once I turn 62 years old, that cost of living adjustment is going to start getting added to my benefit, whether I claim it or not. The minute I claim it, I've kind of locked a number in place. And then that number would continue to get a cost of living adjustment. But again, don't feel that you must claim in order to start that process. You don't. It will be there starting at age 62. We're going to talk about survivorship benefits shortly, but just know that the claiming decision that people make might not just affect their own income, but also it could have consequences on, say, for a surviving spouse or even a surviving child. And then finally, there is some preferential tax treatment. This is something we're seeing some people misunderstand right now. Last year, when the One Big Beautiful Bill was passed, or as I like to say, OB3, because it's much easier to say, there was some noise and talk before that about Social Security benefits being tax-free. That is not the case. Social Security benefits were not part of the One Big Beautiful Bill that resulted in tax-free status. However, it has always been that there's been a bit of preferential tax treatment to your check. In fact, 15% of your check is received free of tax. That's always been the case before OB3 and after OB3. So don't think that your Social Security check is 100% tax-free. It is not, and we're talking about the federal level. So all in all, it's a pretty good benefit. It is called Old Age Survivors and Disability Insurance. It was created in the 30s during the worst depression that we've ever seen, and it was intended to keep the most vulnerable people to falling off the abyss into abject poverty. The next thing I want to start talking about is, how do you get your check? Or rather, how is it calculated? Well, the first thing you want to know is that if you're looking at your own benefit, if you have worked for 10 years or for 40 quarters, those quarters, by the way, do not have to be consecutive. If you've worked for 10 years or 40 quarters, that gets you a ticket to the dance. And now you can claim Social Security benefits based on your own work history. The next thing they're going to do is they're going to calculate something called primary insurance amount. Now, your primary insurance amount is the amount that you would get if you wait till full retirement age. Remember, full retirement age is 66 or it's 67, or it falls somewhere in between for everybody here on the call. Now, the way they calculate your check is this. They're going to take the highest 35 years of wages. Now, if I only worked for 10 years, then they've got 25 lines that they need to fill with something. And if I didn't have any wages, then they're going to put a 0 on that line. If, on the other hand, I worked for, say, 30 years, they're going to take 30 years of wages, and 5 of those lines are going to have zeros on them because I didn't have 35 years of work history. If I work for 45 years, then that puts me in a much better position because they're going to cherry pick the top 35 years of wages whenever they happened. And if some of those wages happened years and years and years ago, which of course they did since I've worked for 45 years, allegedly, then those wages are actually calculated to reflect a current wage base. So in other words, they're kind of adding an inflationary factor to it to make it more relevant. So they're going to take they're going to look at those 45 years. They're going to cherry pick the top 35. They're going to apply a calculation to it, and that's determining my primary insurance amount. Every year, if I've got another year of wages, they will recalibrate this number. Now they've got 46 years of wages to contend with. And again, they'll go back, they'll cherry pick the highest 35, and then my primary insurance amount would be recalculated every year as long as I continue to work. So that's how that works. And at the same time, we always suggest review your statement. It's changed over the past 5 years or so. It's become a lot more abbreviated. And there are a few things I'll point out you want to probably review with your advisor. The first thing is, and this is, you're going to see a little aqua box kind of around the area that I'm talking about. But the first thing they're going to do is show you your retirement benefits. And they're going to start at age 62 if you are 62 or younger, and they're going to show you what your monthly benefit would be for each one of those years, depending upon when you claimed. The other thing I'll share with you that's a fairly common misconception is that people think if they claim, let's say at 62, that as they age, their check will go up. That is not true. It's not going to just keep going up because you're getting older. It will go up because of the cost of living adjustment, but not because you're aging towards full retirement age. So that's your retirement benefit. There's a spot there for disability benefits. There's a spot there for what your survivors would get if you passed away. And then on the right-hand side, we always say every year, just make sure that they got your income right. Your income is going to be provided to Social Security by the Internal Revenue Service. There's a cap on income every year. This year, it's about $180,000. That's the amount that you pay Social Security tax on. And then they're going to kind of use that to figure your primary insurance amount and your tax, your Social Security tax. I'm not talking about taxes you pay on your benefit. I'm talking about the FICA tax that they take out of your paycheck. So you just want to make sure that your earnings are reflected accurately. Now, I'm going to put some actual numbers to this because so far I've talked about if you claim early, there's a reduction. If you claim later, you get more money. So I want to actually put some real numbers to this. And what we're going to assume here is that we have an individual whose full retirement age is 67 years old. And if they wait until then, their benefit would be $2,000. They will get all 100% of that because they waited till full retirement age. If they claimed as early as 62, that reduction would be a 30% reduction, and they'd only receive 70% of that primary insurance amount. And again, for every year that they get older, it's not that their check's going to go up until they start receiving $2,000. That $1,400 would be locked in place. And the only way it would go up is because of the annual cost of living adjustment. All right. So on the flip side of this, if this individual waits 1 year and then claims, they are going to get another 8% on top of that. So they receive another $160 a month. And then it goes up to 16% and 24%. Remember what I said earlier, once you hit age 70, those delayed retirement credits stop. And those 8% delayed retirement credits are no longer they'll be available to you, but it's not going to continue on as you age into age 71, 72, and so forth. So that's how that works. And I'm going to come back to when we talk about spousal benefits. There are over 2,400 different filing rules. And so as you can imagine, it becomes somewhat complex. And tonight, we're really going to talk and concentrate on the top three areas there: spouses, surviving, and divorced spouses, because we have found that that touches probably about 98% of the individuals on our calls and in our presentations. However, should you have questions about dependent children, survivorship benefits for children, if you or a child is disabled, if you are a government employee, then by all means, reach out to your CNA advisor, and they will be able to direct any questions to us, and we can help you out there as well. Well, let's start talking about spousal filing rules. I could claim a Social Security benefit off my spouse. That's called an auxiliary benefit. And of course, there are eligibility rules. If I wanted to do that, I'm eligible at age 62. 62 is kind of that magic age. Of course, every rule has an exception, but for our purposes tonight, we're going to kind of stick with this age 62. So I could claim a benefit off of my spouse, and I would be able to do so if, number one, I was at least 62 years old. Number two, we'd been married for at least 1 year. And number three, in order to make this happen, my spouse must actually file for their own benefit. And once that happens, then that window or door, I guess, would be open for me then to claim a spousal, Social Security spousal benefit. Now, a couple of things before we move on. First of all, I might at this point be eligible for two different benefits. I might be eligible for the benefit that I'd receive based on my own work history. And if I met these three elements on the left, I would be eligible for a spousal benefit. but you cannot take any more than one check at a time. I cannot take my own benefit and then add a spousal on top of that. It's one or the other. And if I'm smart, I'm going to take the one that's bigger. In fact, I think Social Security forces that issue and makes you take the one that's bigger. So the next question is, well, how much would I get as a spouse? We already talked a little bit about how much I would receive under my own work record. That's that primary insurance amount. It's calculated looking at your top 35 years of wages, et cetera. But when I'm looking at my spousal benefit, what I would receive is up to 50% of their primary insurance amount. Now, in order to explain this better, we're going to go back to this chart that I showed you just a moment or two ago. My spouse's primary insurance amount is $2,000. That's, remember, primary insurance amount is the amount that anyone receives if they claim at full retirement age. Their full retirement age is 67. Their primary insurance amount is $2,000. Don't be fooled into thinking that you would get 50% of their check. Because what if their check is $2,480? You're not going to get a check that represents $1,240 or half of the $2,480. You're capped at that $2,000 in this example. Now, the reason they say up to 50% is, what if I claim a spousal benefit and I'm younger than my own full retirement age? Well, in that case, they'd use $1,000 as the starting point, and they would reduce it according to what age I was when I claimed a spousal benefit, assuming I was younger than my own full retirement age. It can get a little wonky. I get it. And that's why we have the tool that I will share with you in about 10 minutes or so. So just remember, spousal benefit, half of the spouse's primary insurance amount, not the total benefit. If the total benefit is the age 70 benefit, that's not what we're looking at. And then again, that half of the primary insurance amount could be adjusted downwards depending upon when you yourself claimed and how old you were. That's how the spousal benefit works. Now, the survivorship benefit works a little differently. So this survivorship benefit has to do with surviving spouses. And the eligibility requirements are right there on the left. You have to be married for at least 9 months. This time, remember I said every exception has a rule? Well, every rule has an exception. Well, here's one of those exceptions. That is, I could take my survivorship benefit as early as age 60. In fact, you might hear this benefit referred to as the widow's benefit. That is not entirely accurate because widowers would be eligible for this as well. But the reason they call it the widow's benefit is because more than 95% of this benefit is paid to women. Why is that? It's because women statistically are the surviving spouse. And so even though you might refer to it or hear it referred to as a widow's benefit, it could go to men or it could go to women. Now, you can take this as early as age 60. Would it be reduced because you did not take it until full retirement age? Because you claimed it before your full retirement age? Yes, it would. If you wait until your full retirement age, just like any other benefit, you will get 100% of the benefit you're eligible for. But if you claim this survivorship benefit as early as age 60, it would be reduced. Now, here's the other thing. You will receive that benefit for the rest of your life. And that is important because when we look at how much the benefit is, you'll find that important. However, if you remarry before age 60, doesn't happen often, but sometimes if people are widowed or widowered at a young age, if they remarry before age 60, they relinquish all claim to the survivorship benefit. So important to know how much it is. And it's pretty easy if you kind of don't read the part on the right because it's a little involved. It's much easier if I explain it to you. Essentially, the amount of the survivorship benefit is the amount that the deceased spouse was receiving. So in this case, in this case, if my spouse was receiving $2,480 and then passed away, that's my benefit. No half, no full return, no primary insurance amount only. I would get the exact same thing. It's almost like a relay race, if you will. My spouse has that benefit they're getting. They pass away. They pass that baton to me, and I'm going to take that amount until I myself pass away. There are provisions made if someone passed away before having claimed. There are calculations made if people passed away before full retirement age. So there are a lot of different survivorship benefit calculations, but do know a few things. First of all, it's almost as if you scratched out your spouse's name on the check. And don't take me literally there. It's not a check. It's a direct deposit. But it's almost if you scratched their name out, wrote yours in the spot, and took it and it was paid to you for the rest of your life. Just like the other benefits, you cannot take more than one. And the other thing is, if my own benefit based on my own work is, say, $3,000, well, clearly, I'm just going to stick with my $3,000. I'm not going to exchange $3,000 for $2,480. So whichever is the bigger check is the one that I will continue with. And that's how surviving spousal benefits work. Now, at this point, I'm going to make things a little more muddy. What happens if I remarry and say I'm, I don't know, 65 years old? Now it is conceivable that I'm eligible for 3 benefits: a spousal based on my new spouse. Remember, that's half of their primary insurance amount. My own based on my own work record, and my survivorship benefit. And in that case, again, you would get the bigger of the 3. You can't add them all up. That would be great, but you can't add them all up. So just be aware that there might be, 3 different plates spinning in the air there. And that's where, again, we can help you with that. Social Security will almost always give you the biggest of the 3. Really very few reasons why you would want to do something different. But just be aware that could well be the case. And if you remarry and now are eligible for a spousal benefit, well, that's half of the primary insurance amount. And it very well could be that your survivorship benefit is much more than the spousal benefit that you would be eligible for on your new spouse. So hopefully I haven't totally baffled you. That's why we have tools available. But before we move on to that section of tonight's presentation, we're going to look at what happens if you get divorced. People are starting to plug into this a lot more. When we started this presentation 13 years ago, people were really a little confused about how the divorced spousal benefit worked. First off, if I have been married to my spouse for 10 years or more, and we got divorced, and now I am unmarried, then I would be eligible for a Social Security benefit based on my former spouse. Now, a lot of these spousal and divorce spousal benefits were created back in the days when women got married and then they stepped out of the workforce to raise the family, and they may never have gone back to work, or if they did, it might have been part-time. Their income was really reduced. And so there were provisions made for kind of stay-at-home moms, if you will, or homemakers, and this one is no exception. So if you had been married for at least 10 years and you're unmarried, then you could file a claim or a Social Security claim based on your former spouse's work record. 2 things we get asked almost always. Number 1, does my former spouse know that I am claiming a benefit based off of them? The answer is nope, not unless you tell them. Your divorce decree is a matter of public record. It's always great if you have that information with you, but they can find it out. But your former spouse does not need to know that. Actually, there are 3 things you should know. 2 questions. The second question, what if my former spouse remarries? And then the answer, I say kind of tongue in cheek, is send them a card. Go to the Hallmark store, get them a congratulations card, and send it to them. And they say, no, what happens to my Social Security benefit? And I say, yeah, I know that's what you really needed to know. The answer is nothing happens to your benefit. You're going to get the same benefit whether your spouse stays single for the rest of their life or it gets married and divorced, doesn't matter. Your check does not change. Now, the other thing is, if you remember when you were married, your spouse, if you wanted to claim a spousal benefit, your spouse had to file their benefit. And that's what provided you with eligibility for a spousal benefit. Remember, you could do that after you've been married for 1 year, not 10. If you're still married, 1 year is the rule. If you're divorced, it's 10. Now, can you imagine what would happen if you had to wait for your ex-spouse to file their benefit in order for you to be able to claim a Social Security benefit off of their work record? If you had a real high earning spouse that didn't need their Social Security benefit and consequently said, I'm not going to claim, and that is going to prevent you from claiming a Social Security benefit based on my work record, or words to that effect, that could be devastating for some people. So now the rule says is that if you have been divorced for 2 years or longer, you can go ahead and file a benefit or an ex-spousal benefit, and your former spouse doesn't have to have filed. It doesn't matter whether they filed, not filed, whatever it is. Once a divorce is 2 years aged, go ahead and file if you want to. The benefits there are really quite simple. You would get the exact same amount that you would receive as if you were still married, half of their primary insurance amount. And the survivorship benefit is exactly the same as if you were still married, which is you get whatever they were getting. Now, Social Security, especially after the DOGE cuts, is a little short-staffed. And they might not be terribly proactive. So they're not going to be chasing you around, letting you know that your former spouse has passed away. And that might result in an increase in your check. So you kind of want to stay on top of that if that's your case. But do be aware that the benefit that you'd receive as a divorced spouse, exactly the same as if you were married. And as an ex-spousal survivor, exactly the same as if you were still married. So a lot of moving parts. Remember, 2,400 rules, and we just talked about, the top 3 situations. And that's why at Nationwide, we have provided our friends at CNA with a tool, access to a tool called the Social Security 360 Analyzer. Now, I'm going to walk you through this for about 5 minutes because it's very simple, not because I'm running low on time. The timing's just right. But I will tell you 3 things going into this. Number 1, this is a service that we've provided your advisors. And so it is provided to you at no charge. There's no charge. There's no obligation. No one will come to you and say, well, you need to buy a Nationwide product. And that will never happen. And it's confidential. This is something that we feel very strongly will help people and their advisors make a really good decision within the framework of all of the retirement income choices that abound out there. So let's take a look at how this works. First of all, I'm going to show you what the report looks like. So I'm going at this a little bit backwards. Remember Pat and Kelly? We met them on slide 5. Well, this is their report. So there are some screenshots I will share with you. I'm not going to show you every single page, but I think it's actually pretty easy. One of the first things you'll see is this is a report that has been customized for Pat and Kelly. Their filing situation is somewhat straightforward, but if you had been married and divorced and married and widowed and you are disabled, it will take all of that into consideration and then put forth 3 filing options based on the amount of income it's going to provide. And then you and your advisor can determine which one fits best into your overall retirement income plan. Now, you're always going to have one on the left that's called suggested simply because it's the one that's going to generate the most money. The one on the right is the option that shows what the amount of income would be if you claimed this as early as you possibly could. And then there's an alternate. And almost always people select an alternate that says, I kind of think of it as the Goldilocks theory, neither too hot nor too cold, which means what happens if I don't delay claiming and take advantage of those 8% credits, nor do I claim earlier than full retirement age and get a reduction in my benefit. What if I just claim at full retirement age? And that's what the aqua bar looks like. Now, for each one of these options, there's 3 bits of backup information. And what I'm going to do is share with you what those 3 bits are for the one on the left, the suggested option. First of all, it's going to tell Pat and Kelly what to do and when to do it. So Pat waits till 70. He files a standard application. That's a term that the Social Security Administration understands. We've seen people come back and say, I told Social Security I wanted to do this or that or the other thing, and I got something totally different. And we said, yes, that's because you used a mashup of terminology and they had to guess at what you meant. So we want to avoid that. And we're going to tell you exactly what the terminology to use is. Kelly files a standard application, and she does so at full retirement age. In her case, it's 66. I'm sorry, it's a little earlier, in fact, than her full retirement age, but the numbers worked out. It was just one of those funny little quirks. The next thing you will see, and I think this is a really great representation of how things work out for Pat and Kelly. The orange bars on our report are showing, it's looking back in time and showing their income that they were receiving when they were working. Then they retire. There's a little bit of a delay before they claim. And then those black bars show how much income they're getting from Social Security. Now, there's a little gray bar or a line that swoops from bottom left or that starts swooping up to the upper right-hand corner. That's the amount of income that Pat and Kelly said they want in retirement. It's going to pay for their essential expenses as well as their discretionary expenses: food, clothing, shelter, transportation, healthcare, and the fun stuff. Now, you can see that for that income need that they have, I like to think of it as a bucket. And Social Security was never intended to provide anybody with all of their income needs in retirement. It's going to fill up only so much of the bucket. And that's where you sit down with your advisor and say, all right, what do we go to make sure that that bucket is filled up? And so they're going to look at your other sources of income: your 401k, your IRA, your brokerage account, your inheritance from Aunt Mildred, whatever it is, that's what you're going to draw on to fill up the rest of the bucket. Now, in this case, you can see that the amount of income drops. Why is that? Because Pat passed away. And since Kelly can only take 1 check at a time, only 1 check's coming into the household, not 2. So there's no more check coming in for the couple, but Kelly is able to swing over and pick up the amount that Pat was getting because the survivorship check was bigger than the check she was getting. Now, if you're looking at this and thinking, well, all that looks really great, but how much are we talking about year over year? That's the third bit of information. And this is simply a cash flow that shows that bar chart you saw on the former slide in actual dollars and cents. So going forward, when Pat is 79, I'm looking at the first row here. When Pat's 79 and Kelly's 73, they've got a certain amount of Social Security coming in to total $77,736. Their income need increases every year because of cost of living and inflation. And so their shortfall is $41,894. That's the amount that those other sources of income need to solve for. And so you can see year over year, it shows what's coming in, what's going out, and what the shortfall is. And that's a huge help to any advisor as they begin to create a retirement income plan for you. So how do you get this? It's pretty simple. We do not want your Social Security number. We do not want a copy of your statement. But what you'll do is fill in this fact finder questionnaire. Your advisor can provide it to you. It might take 10 minutes. Again, we don't want your Social Security statement, but it's probably not a bad idea to have your most recent statement in front of you so that you can fill in most recent information. There's a front and a back, pretty easy. You provide it to your CNA advisor. They send it to us. We will send them the report. That's how legal wants it. And anyway, the your advisor can then take a look at it and start putting maybe some ideas and thoughts together. And then you'll have something, again, that is customized to your specific situation. So, as we wrap up, I want to kind of finish and wrap up with three different thoughts. Number one, hopefully by now, you realize that it's not just when you file, but how you file is super important as well. The second, so many people think of their own Social Security claiming and when they claim and so forth, but it is super important to understand how that claiming decision affects other family members, particularly a surviving spouse, and how you can make those rules work to your best advantage. And the last thing is that Social Security, big decision, it's the choice of a lifetime, but it's not the only piece of the whole puzzle. You want to be thinking about the other pieces of the puzzle and how they all work in concert in order to construct a retirement income plan where you can get the most money out of this government program that is coming to you. So, with that, I'm going to turn it back over to Frank. I want to thank you so much for taking the time today. I really appreciate your questions if they come in, either now or in the future. I know I'm at time, so Frank, I'm going to send it back to you to see if you have any final thoughts or to wrap it up.
No, Roberta, as always, we love when you present and that you're with us. You did a great job as always. And again, for all of our guests that are on us this evening, and for those who are following this afterwards, again, you can reach out to your CNA advisor if you have questions. I would strongly suggest that you go through the process and at least know what your numbers are, check them. It's interesting. I see this presentation, periodically that we do it, and I always pick up something myself, and I'm in the business, so there's a little nuances that you pick up here and there. So it is a big decision. It's important. It's a critical part of anybody's planning. And so, at any rate, I would like to thank all of you for being with us this evening. Roberta, thank you so much for sharing your insights. We appreciate you
My
and
pleasure.
appreciate our relationship with our partners over at Nationwide. And having said that, I wish everybody a lovely evening and enjoy the rest of your summer. And we look forward to catching up with everybody on our next program. Thank you so
Thank
much and
you.
have a great evening. Thank you, Roberta.
Most welcome. Thank you. Take care, everybody.
Take care.